I'm absolutely a believer in having both active and passive. There are some areas where active is very good. There's some areas where passive is very good. And really, there's some common traits you want either way. You want low costs, you want diversification, you want a good strategy.
Do mutual funds still work for investors is the focus of Consuelo Mack Wealth Track.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. 2024 is the 100th anniversary of the mutual fund. And as the late comedian Rodney Dangerfield would put it, I don't get no respect. Upstart exchange-traded funds, or ETFs, which came on the scene in the U.S. in 1993, are now attracting massive money flows and are rapidly gaining on traditional mutual funds, especially among younger investors. By year-end 2023, open-end mutual fund assets, including equities, bond, and hybrid funds, had reached $25.5 trillion, whereas Upstart ETFs had risen to a little over $8 trillion and were gaining fast. In this era of instant online trading, the ability to buy and sell these portfolios of securities during the day on a stock exchange fits the moment. But it all started back in 1924. That is when the Boston-based firm MFS, which is still in business today, created Massachusetts Investors Trust, the first U.S. open-end mutual fund. The fund is also alive and well and carries a silver medalist Morningstar rating. Its introduction was revolutionary. For the first time, ordinary individuals were able to buy shares in pools of securities managed by professional investors and sell them. Since then, the democratization of investing has expanded to just about every other asset class and is available in multiple forms: closed-end funds, collective investment trusts, or CITs, index funds, exchange-traded funds, and target date funds, to name a few major vehicles. Now, given all of these choices, how useful is the original open-end mutual fund? We will put that question to today's guest, who we are delighted to say has been a Wealth Track guest in several of our past 20 years. He is Russell Kinnel, Director of Manager Research for Morningstar Research Services, a wholly owned subsidiary of Morningstar, which is celebrating its 40th anniversary this year. Kinnel heads the firm's North American Morningstar Analyst Ratings Committees, which vet the Morningstar Medalist Ratings, which we cite often on Wealth Track. He is the editor of the monthly Morningstar Fund Investor newsletter, writes the Fund Spy column for Morningstar.com, and has published numerous studies on the mutual fund industry. As his bio says, since joining Morningstar in 1994, Kinnel has analyzed virtually every type of fund and covered the most prominent fund families. Recently, Kinnel published his very popular annual Thrilling 36 list, which narrows the universe of 15,000 fund share classes to between 25 and 50 funds that meet a few simple and strict criteria. We discussed how the Thrilling list is put together in a recent Wealth Track episode, which is available on wealthtrack.com. Well, this week we asked Kinnel for some perspective on the open-end mutual fund. A century in, what difference has it made to individual investors?
You know, it really was a big deal. It started off humbly enough with just a couple of funds, but there were really some important ideas. The first one is maybe smaller investors pooling their money to have a professional run a diversified portfolio that they couldn't build on their own. And from that humble beginning, it became a $1 trillion industry that helped millions of people retire comfortably. It helped millions of people reach their goals. It had a lot of innovative ideas that we all take for granted now, just as we take everything else invented 100 years ago for granted. But there really were some important ideas embedded in there that worked very well for us and made investing a safe place for investors.
What were the best ideas for investors that came out of the creation of the mutual fund?
The mutual fund being created in 24, and then later the 40 Act, which really helped solidify the fund industry. But just basic things like having an accountant, having a board of directors responsible for the fund. Having a custodian is huge because that prevents managers from stealing money directly. Just about any investment vehicle you can think of, some people have swiped money, but you can't do that with a custodian, and there really has never been a case of a mutual fund actually stealing because they can't just say, yeah, give me all that money. It's a custodian is holding that. So very simple principles, rules for diversification, which again, reduce the amount of potential losses and risk. And all of these sort of common sense rules, daily net asset value. Mutual funds are a long-term investment, but somehow it's very comforting knowing that you can take your money out any day, knowing that it's priced every day so that you have transparency. You have transparency about who runs the fund, about what the holdings are. All of these very basic things actually are really powerful.
You know, it has not been entirely smooth sailing, however, so there have been a number of scandals.
Yeah, the mutual fund industry largely made it scandal-free all the way until 2003, so 80 years in, more or less. I think because they had been kind of lightly regulated, overnight they went to a heavily regulated industry because Eliot Spitzer, then the New York Attorney General, and then later the SEC, started digging and actually found a number of issues. Some of it were minor things like allowing frequent trades in and out, which essentially offloaded some trading costs onto shareholders. But other things were much more serious. We found out about there was some front-running cases. So a number of unpleasant things came out, and the squeaky clean industry reputation was no more. But on the plus side, what came out of that were some reforms, and I think a recommitment to the fiduciary values that investors need and that the fund industry has to deliver to have a good value for investors.
Do you think that the industry is pretty well regulated and basically has got its act together so that it's a safe place for investors to be?
I think there's still some transparency things that can be improved. For instance, out of that scandal 20 years ago came the reform saying you have to disclose how much the manager invests, but they capped that out at $1 million. They should just say, how many shares do you own in the fund? Update it once a year so we can really see how much do you own. But I think in general, the fund industry is in a really good place.
Let's talk about some of the evolution in the mutual fund industry. And one of them, of course, was index funds in the 1970s, thanks to really one of your industry heroes, Jack Bogle at Vanguard. That was a major evolution. Obviously, that introduced passive index funds, which have become huge. In the 1990s, exchange-traded funds were introduced, a whole new kind of species of fund that has become incredibly popular. Now we've got active ETFs as well. So do you want to take us through a little bit through the evolution through those changes, those innovations, and how they are changing the industry?
Absolutely. Great place to start. Jack Bogle and Vanguard, they really raised the bar for everyone. Vanguard was Bogle's brainchild, and the idea was to have a fund company that's owned by fund holders, not other stakeholders, so therefore they could charge more or less at cost rather than the norm, which is cost plus as big a profit margin as you could get away with. And of course, indexing is the perfect vehicle for that because indexing, you don't have to pay for a manager. You can run an index fund at a lower cost than an actively managed fund. And so that meant it was easier for investors to see those gains accumulate, and that cost advantage multiplies over time. Yet until ETFs, indexing was really just for Vanguard. Advisors, brokers, and planners didn't really have a way to get paid putting people in those. So therefore, most of Vanguard's business was direct. But ETFs came along, and they have all of the servicing fees stripped out, so there can be very low cost. And all of a sudden, this is a way for planners and brokers to put their clients in a lower cost vehicle. And so now passive investing and lower cost ETF investing grew. And again, I think that's a win for investors because fees have come down. Investors are paying a lot less for their funds, whether it's ETF or actively managed open-end. They're paying a lot less, and that means more to them and make it easier to reach their goals.
Give us the pros and the cons of the open-end mutual funds, the traditional one, versus exchange-traded funds. Well, what are the pros for each, and what are the negatives?
One of the biggest issues is around taxes. Mutual funds are taxed in a way that's less advantageous than ETFs. The main way being mutual funds, if they realize capital gains, have to distribute that to all of their shareholders, whether or not the shareholders actually made a profit, whereas ETFs have a mechanism to prevent that. So ETFs are generally a more tax-efficient vehicle. Another account in ETFs' favor is you can trade them all day. That means kind of they can work as a casino, or they also function wonderfully as a long-term investment. But there is that added convenience. And now a lot of investors who have started investing in the last 10 years just have naturally gravitated toward ETFs and don't really want to have an open end. But there are advantages for open end funds. One key thing is in less liquid areas, they really have an advantage. It's harder to index less liquid areas, but also it's harder to meet that minute-to-minute liquidity that ETFs require. And so there are areas that you just don't work so well. So high-yield bond funds, muni bond funds, emerging markets, small cap stocks, those all work better in an open-end format. Now, maybe down the line there will be some innovation that tilts it in ETF's favor, but there are still some places where open-end funds have the advantage.
If we're holding an open-end mutual fund, which many investors obviously still are, is there an advantage to converting to an ETF?
If it's tax-free, that there might be an advantage. Another element is some funds now have an ETF share class of the open-end fund, which allows the open-end fund to move those taxes over to the ETF. In that case, it probably isn't necessary to convert. But it's definitely worth looking at. Is there a cheaper ETF version of what I own? Are there tax implications? Do I need to do that? So good questions to have with your broker, your financial planner, your accountant, or maybe the fund company directly. It is something that's another new wrinkle as we're seeing Vanguard pioneered this ETF share class. That idea has gone off patent, and so now anyone can use it, and we're seeing a number of fund companies adopt that.
We've had you on WealthTrack in the past where you've talked about, you publish a couple of things annually, and so one of your publications has been where you share your top 10 personal holdings in your long-term retirement portfolio. And if memory serves me correctly, Russ, I think that your holdings are primarily still in traditional mutual funds. Is that right? And are you tempted to do any conversions to ETFs?
You're right. Most of my money is in open-end funds. I do have a couple of ETFs, which I added in about the last year. And most of my money in mutual funds is in a tax-sheltered account, so it's not really necessary, but I continue to watch that. But yeah, there are a couple of ETFs I own. I think it's an attractive way to invest.
So Russ, which ETFs did you add to your portfolio recently?
T. Rowe Price Capital Appreciation is now available as an equity-only ETF. So the open-end fund is an allocation fund run by David Drew. Great fund. It's been closed for a long time. So what T. Rowe did was they took the equity-only portion. So it's not a clone, but you can get the equity-only portion in an ETF. And the other one I bought was Vanguard Dividend High Yield Index, which is a dividend-focused index fund. And I wanted that just for a pure value play. It's got a significant yield focus, and that yield focus anchors it in value. And of course, it's extremely low cost. So that appealed to me as well. With this growth rally, my portfolio, like a lot of other people's, got a little more growth centric, and I wanted to have some more pure value that would work as an anchor, because when growth sells off, that true value often holds up nicely in a growth sell-off. Not always, but I wanted to make sure I had significant exposure there.
Speaking of low cost, which, as you said, that the ETFs offer, it is the compression of fees putting a tremendous pressure on mutual fund firms. And essentially, can you make money on the traditional mutual funds now with the kind of decline there has been in fees, which have been substantial?
The open-end fund industry is still a very scalable industry. So a lot of them are having outflows, and there is fee pressure. Some are cutting their fees, but they're still tremendously profitable. I think probably the greater threat is from the outflows in general, but I think the biggest threat to the fund industry is if you're a mediocre open-end active shop, then you really don't have an advantage and a selling point. If, on the other hand, say, you're an outstanding bond manager or equity manager, or you've got a niche like high yield or something, you're absolutely in fine shape. The stronger firms continue to grow nicely, but I think it's those mediocre firms that try to be offer something for everyone, but never really became great at anything. Those are the ones that are most under threat. I think we'll see more mergers with those in particular. But the bigger players, many of them already have ETFs and index funds and are already pretty scalable. So the big fund companies are still in a very strong position.
Let's talk about those big fund companies, because the big fund companies are getting bigger. I mean, the flows going into Vanguard, for instance, are just staggering. We're talking about Vanguard and BlackRock and Fidelity. Does the kind of concentration that you're seeing in those funds, is that worrisome at all?
It doesn't worry me at all.
Why not?
Right. So Vanguard and BlackRock and Fidelity are managing more than they used to.
Yes.
And it doesn't worry me because they have to be fiduciaries to everyone. So they can't say, we're going to act unethically over here, or we have an agenda, and they have a diverse shareholder base. So it's incumbent upon them to vote proxies. And so they need to do that in a responsible way. They've got all of these different mandates, and a lot of that index money is very diffuse portfolios. So I'm not too worried. If you think about it, maybe 30 years ago, a lot of that money was held by pension funds, and they were very concentrated. So moving from, say, CalPERS to Vanguard and BlackRock doesn't really concern me all that much. I think there are a number of safeguards in place, and potentially down the road, we'll see more people move in the way BlackRock has, which is finding ways to actually enable fund holders to set policy for voting those proxies. But so far, I really haven't seen any worrying signs.
Let's talk about some of the innovations that are happening with ETFs and the positives and the negatives about them.
So a couple things come to mind. One is actively managed ETFs is really a growth area. And I think it makes sense because it's a way for managers to offer a lower cost vehicle that's more tax efficient and also meets people where they invest, right? More people are comfortable with ETFs, so why not do that? And I think over time we'll probably see more innovation so that more types of funds. Right now, a lot of these active funds are, say, in large cap where there's a lot of liquidity and it's easy to do. But I think over time we'll see some more. And then another part of that story is crypto ETFs. They got SEC approval and they hit the ground running. A lot of money is going into crypto ETFs. I'm not sold on them yet. There are some issues with the way they're designed, as well as obviously the underlying crypto. I'm a little skeptical there too. I'm not saying it won't work or you shouldn't invest, but it is an important innovation. It is an interesting area of change. We're watching it closely, but we're not yet ready to tell people, yeah, go buy those crypto ETFs.
Is this a caveat emptor for investors? What's your take on the fact that Wall Street is now embracing crypto, whereas many in the industry said they would not?
Crypto has gone mainstream, BlackRock and Fidelity have crypto ETFs that you can buy, and they're at much lower cost. Before the SEC allowed ETFs in this space, it was pretty costly to get in, but now it's mainstream and really lots of ways that you can buy crypto from brokers. And so it really is very easy to access now. Whether you should access that or not is the big question, and I'm not sure. We talked about one of the great things about mutual funds was diversification. You could buy a portfolio of 100 stocks, 200 bonds, and diversify your assets. Well, if you buy a Bitcoin ETF, you just have Bitcoin. Or maybe you could buy a basket of crypto, but they all seem to move together at once.
Right.
So I would say absolutely be careful, understand that this is a new product and we really don't know where it's going to go. I'm not touching it, but maybe it is a good place to invest. I really don't know. So don't take the fact that BlackRock and Fidelity have products there that you should invest there. So I would definitely take a big grain of salt, but it has become easier. And obviously I think it probably feels a little safer knowing BlackRock and Fidelity are trustworthy firms, but obviously the funds will live and die by where crypto goes. So the fact that they're trustworthy firms, if crypto goes down 70%, their funds are still going to go down 70%. So it's a very hard thing to predict right now.
There's been a lot of innovation over the years in the mutual fund industry. And one of the most recent ones is the active ETF space. Is that where we're going to see more products coming out and more innovation?
Absolutely. Active ETFs are really growing quickly, and just about every big fund company has active ETFs. And even those that don't, almost all of them are planning active ETFs. So look for a lot more active ETFs. They're a lower cost, more tax efficient version often of an active fund.
Where do you come out in the active versus passive debate?
I'm absolutely a believer in having both active and passive. There are some areas where active is very good. There's some areas where passive is very good. And really there's some common traits you want either way. You want low costs, you want diversification, you want a good strategy. If I can get an actively managed fund for 30 basis points, then I'm really not paying much versus passive. So for most people, it just makes sense to have both.
The one investment for long-term diversified portfolio, when you were on first on WealthTrack in 2013, you recommended the Dodge & Cox International Stock Fund, which has done extremely well. That's actively managed. And you also, last year, recommended the Dodge & Cox Global Stock Fund, which has also done well. So what would you recommend today?
So I still love those Dodge & Cox funds, but I thought I would come up with a small value fund because everyone is excited about AI and the weight loss drugs for a good reason. Those companies are growing tremendously. So large growth is very hot. And so when large growth gets really hot for a long time, I think about small value. So in this case, I like silver rated Janus Henderson small cap value. Justin Tugman and Craig Kempler are the managers, and they really run a nice sort of cautious strategy. It's quality companies with competitive advantages at low prices, and that gives a nice defensive characteristic. So when the market goes down, they tend to lose less. When the market really rallies strong, they're not going to be that exciting. So it's not an exciting story as much as it is a comfortable one. So I'm a contrarian. I like small values.
Russ Kindle, thank you so much for joining us. Congratulations, number one. It's Morningstar's 40th. I think it's your 30th at Morningstar or a little bit over. So congratulations as we celebrate our 20th season on WealthTrack. It's great to have you back.
Thank you so much and congratulations.
At the close of every WealthTrack, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is see if your mutual funds offer an ETF version. Many mutual funds do now offer an ETF equivalent. Converting a mutual fund to its ETF equivalent is usually a tax-free event. Fees on ETFs are generally lower than on mutual funds. Capital gains distributions from ETFs are much less frequent, and they don't have shareholder redemptions, which means in challenging markets, they aren't forced to sell securities. ETFs trade like stocks during the day, offering investors greater flexibility. That last point is one of the main reasons that Vanguard founder and index fund pioneer Jack Bogle was against ETFs. He felt that the option to trade and market time with them would be too tempting for most of us mere mortals. Needless to say, Vanguard was one of the first big firms to offer ETF versions of many of its mutual funds. They have turned out to be wildly popular. Next week, Social Security guru Mary Beth Franklin gives us a realistic assessment of the retirement plan's health, find out how worried or reassured we should be. In this week's extra feature, Russ Kindle recommends one of his favorite books. If you are so inclined, please follow us on Facebook, X, and our YouTube channel. Thanks for continuing to spend time with us as we celebrate our 20th season. Have a super weekend and make the week ahead a healthy, profitable, and productive one.